pretty consistent on message about the robo-advisor opportunity for about the past 5 years. And the message has really been this: at some point, everyone's going to have the technology, right? My good friend Josh Brown used to say, I was around when email got introduced, and you didn't call everyone email advisors, right? So the asset allocation bucket, and we've been saying this for a long time, is becoming a commodity on the buy and hold passive side. Now what we've seen in the market has voted is the robo-advisor plus advisor has been the most successful model. Vanguard's a good example. They've raised more money than the rest of the robos combined. Doesn't mean there's not room for probably a dozen independent robos, just like the ETF space. But in reality, what's going to happen is most asset managers and planners will adopt them, and kind of what people call the cyborg model really become the most popular. I think a lot of people are reticent to add the robo component, because I think a lot of people still think that the asset allocation side is a big value add. And there's a little bit of fear that says, hey look, if I just outsource this, if I do this buy and hold, and that's not what we do, remember, but if we do this buy and hold allocation, then how am I going to justify my fees? But that's not the value of an advisor in the first place. The value of an advisor is in wealth planning, estate planning, insurance, behavioral coaching, tax management. And so once advisors kind of, this thought clicks in their head, they says, okay, I can automate the investment side, it frees up their time to do all those other value add things, or play golf, prospect, do whatever to grow their business. But really it's kind of a moment of aha, rather than once they realize it's not a big threat. So Cambria's core offering has always been a quant focus, rules-based portfolios. Call it active, call it passive, we have both. So we have about 10 ETFs, we're managing right around $1 billion, and our offerings range from super low cost, we're the only firm that has a 0% management fee ETF, all the way up to a normal kind of actively managed fee of around 1%, and expands global, passive, everything in between, stocks, bonds. But what we're trying to offer is things that no one else offers, so we're not trying to compete with the Vanguards of the world, so they're niche strategies I want to put my own money into. We're unique in that I invest 100% of my net worth in our funds. A lot of mutual fund managers, it's around 70%, have nothing in their funds. So we want to make sure there's skin in the game. And lastly, develop products that are based on as much academic research as we can. So things that have worked in the past, things that people hopefully want, and things I want to put my own money into. So over the last 10 years, we've developed what we call this holistic strategy, the Trinity portfolios. And it's really what we think is the best of breed for both how an advisor or an individual can behaviorally follow a good investment strategy. So it combines elements of buy and hold, value tilts, momentum, and trend. And the way that we do it is half the portfolio roughly is in buy and hold, so that gives you a fundamental anchor to what's going on in the world. But behaviorally, that's hard to follow, historically because of during the drawdowns and people selling at the bottom, but that also coincides with recessions, people losing their jobs, all that negative geopolitical news. So we pair that with my favorite investing strategy, which is momentum and trend. That's also hard to follow. So a lot of people struggle with putting all their money into a momentum and trend strategy because it often underperforms when the S&P is doing great. Think of the last handful of years. So by putting the two together, we think we can have, at least behaviorally, a great strategy based on academic research that has value and momentum tilts that'll hopefully outperform during the bad times, and most importantly, portfolio people can stick with.